Welcome to our market update and outlook for December 2023. All right, getting straight to our outlook for 2024. Firstly, the big ticket items in terms of macro are really what inflation and interest rates do over the next 12 months, and they've been very, very significant macro drivers over the last 2 years. Our outlook for 2024 is that both inflation and interest rates will be peaking, and that obviously has implications for fixed income as well as equity investors, and we'll talk a little bit more about that. But our expectation is that both inflation and rates will certainly flatten out over the next 12 months. And start to come down. In terms of the economic growth outlook, it's pretty clear that we're facing a slowing environment, and that really is largely down to what inflation and interest rates have done and the impact that they're having on households and the consumer. And we'll talk a little bit more about that in detail, but consumers have basically run down their household savings and are now dealing with rising rents, rising mortgage service costs, and the like, as well as food inflation. So all of that feeds through to slower economic growth. Then moving to some of the asset class views that we've got, and some example investments that we prefer in these different asset classes. Firstly, on fixed income, given cash rates have moved higher and bond yields have also moved higher, fixed income is now a very attractive place to generate high levels of income. And if we do see a slower economic growth and we do see share markets have a bit of a wobble next year, we would expect to see fixed income actually play a diversifier role in portfolios, meaning that if interest rates come a little bit lower from where they are currently, then we would expect to see prices of fixed income investments actually rise, providing a bit of a buffer against the equity market, which could see a bit of a drawdown. Within the fixed income space, term deposits are attractive, paying over 5%. Private debt funds as well as bond funds are also pretty attractive places to generate yield. Turning more to the sort of growth lens, which is really international shares, we remain focused on investing in quality companies that can generate growth irrespective of the economic cycle. The way these companies do this is they tend to have high market share, they tend to have strong pricing power, with customers unable to really substitute their service or product with another competitor. And that simply means that these companies can generate earnings growth through the cycle, as I've talked about. Really the big US technology and healthcare companies are prime examples of these types of businesses that we want to invest in, both long term and also in an environment where the economy is slowing. So we certainly remain committed to those types of investments. Turning our attention to the Australian share market, we really remain focused on investing in both defensive companies as well as companies that are generating high levels of dividends, given our favourable franking system here in Australia. So with that in mind, we're really looking at investments that have less downside capture if the markets were to fall. And we also want to invest in companies that do have pricing power and strong economic moats. And the big healthcare companies certainly tick that box, companies like CSL, for example. Finally, within the property and infrastructure asset classes, it's really about generating income, first and foremost. And within these asset classes, we're really trying to make sure we're investing in more defensive types of assets. So within property, we're thinking about investing in businesses that have industrial assets where they're driven by e-commerce trends, which are very, very strong. And we tend to avoid office and retail where there are structural headwinds facing those types of assets. And within infrastructure, similarly, we're trying to invest in fund managers or exchange traded funds that have more exposure to more defensive types of infrastructure assets, so that in an economic slowdown, those assets will fare better than their peers. So just a quick wrap up of the year that was 2023. It really was a complete reversal from last year. So last year we saw international shares lag and we saw Australian shares hold up relatively well. And this year we've seen the opposite. So we've seen global shares rally over 18% year to date as of the middle of December, and we've seen Australian shares deliver a return of about 5%, and the significant part of that has been in dividends. Now, in terms of why has that happened, so global shares have really been led higher by large US technology firms that have had more resilient earning streams than markets like here in Australia, where we have more cyclical exposure, which is exposed to areas like Chinese growth, as well as banking growth, which is quite slow at the moment, and the resources sector, obviously, which is linked to Chinese growth, which is slowing. The other area that has actually bounced back relatively well, mainly because of the income, is in the fixed income market, so bonds. So bonds are now offering returns that are much higher than they were, thanks largely because of the fact that interest rates have gone up this year quite sharply. And on that point, term deposits are now paying over 5%, so really does provide a good risk-free alternative to taking risk, investing in shares, or for that matter, fixed income more broadly. Turning our attention now to the economic growth outlook here in Australia. So this chart we talked to last update as well, and the story hasn't really changed too much at all. We're really seeing economic growth here in Australia of about 2%, being entirely driven by population growth, and most of that is due to immigration. And really that's the key thing that's saving our economy from a recession at the moment. But the implications of those dynamics are that living standards are coming under pressure. Supply constraints exist in a variety of areas, including the property market. There's been a massive underbuild in the last couple of years, so that's certainly putting pressure on rents and households more broadly. So not a great news story from the individual consumer level, but from the broader macroeconomy perspective, not a bad news story. Now, just diving a little bit more into the inflation story, I guess there's a couple of key messages here. The first one is that inflation has peaked globally. You can see on the chart on the left-hand side that in major economies around the world, inflation is much lower than it was back in 2022, which is great news. And the chart on the right just shows you kind of the rate of change of inflation over time, and you can see that green being low inflation, red being very high levels of inflation, which were kind of peaking late last year, and they've sort of rolled over in most markets, which is certainly a good news story from a trend point of view, but the absolute level of inflation still remains well above central bank targets. And so we're expecting to see central banks kind of being patient before they start to put through rate cuts. And just on the point about interest rates being past the kind of peak level of interest rate hikes, you can see the chart on the left just shows the net number of central banks that are raising interest rates. So when that line is moving up, that's where central banks are hiking rates, and when that line kind of starts to come down, it means they're not hiking, and when it moves below zero, it means they're actually net cutting interest rates. So certainly heading towards that cutting zone in 2024. Whether it comes in the first half or the second half is debatable, but certainly it looks like 2024 is certainly where interest rates will start to see reductions. The chart on the right just shows the outlook for Australian cash rates. At the moment, there's basically another interest rate hike being expected by the markets, versus the kind of current level of cash rates being 4.35%. So whether or not that comes through or not, again, is debatable. We are taking the view that there probably is one more rate hike, just to be on the conservative side, but it all really boils down to the inflation data and what the services inflation data print looks like over the next couple of months. So the RBA is going to be data dependent, and we'll just have to wait and see how that services inflation comes through. Now, we've previously talked about the impact of rising inflation and rising interest rates on the consumer. And the main things that are happening at the consumer level is that savings rates have been drawn down. So during COVID, savings rates were were built up heavily as people were locked down. They weren't able to go out and travel and spend like they normally would. And they were also supported by government cash handouts, which helped boost those savings rates. And you can see that the chart on the left just shows the sharp contraction in those savings rates. So they've basically normalized back towards where they were in the late 2000s, but certainly approaching that kind of zero level, which means that households just are running out of runway in terms of savings. The good news story for the consumer at the moment is the labour market is very strong. The labour market remains very tight, and wages growth has actually sharply increased over the last couple of years towards that kind of 4% year-on-year level. So that is really the key positive message for households and the consumer at the moment. But the key negative is that the savings rates have really been drawn down. So not a lot of dry powder for households going forward. We've already touched on the fact that higher cash rates mean that fixed income is now offering more attractive rates of yield to investors. So I won't dwell on this slide too long. Suffice to say that we're able to generate returns anywhere between kind of 5% up towards 8.5% in various types of fixed income investments, which we think is certainly very attractive for investors that are looking for income generation out of their portfolios. Now, just quickly turning our attention to the global share market, and more specifically the US share market and the Australian share market, respectively. So in the US, what we've seen is that earnings have been very resilient over the last 12 months or so. Earnings are about 7% higher than they were this time last year. And the other thing that we've seen is that valuation multiples have also expanded. They're up just over 10% over the last 12 months, and those two factors have contributed to the rise in the US share market of nearly 20% over the last 12 months. So very, very strong growth there. And as I've touched on before, the positive earnings growth that has taken place has really been driven by those large, high-quality businesses listed in the US. Conversely, in Australia, we've seen earnings deteriorate over the last 12 months or so, and that's really been a cyclical slowdown. Resources and banks have really been the key drags on the earnings for the market here in Australia. Offsetting that has been a little bit of valuation expansion. So the PE multiple has expanded from just under 14 times coming into 2023 up to just over 15 times. So that's kind of meant that the share market as a whole has kind of just gone sideways. So we've had declining earnings, but valuations go up. So really it's about, when we think about Australia as an investment destination, it's really about income generation and investing in more defensive businesses, which includes healthcare and consumer staples. And then just in terms of the outlook for earnings for the Australian and the US share markets respectively, the story of low growth or no growth here in Australia actually continues into 2024. And the story of positive earnings growth does also continue into 2024 and 2025. So that's really the key reason that we do have a preference for international shares when we're trying to build portfolios for growth. And when we're looking for income, we are tilting more towards the Aussie market given those higher yields that we're able to generate here. So just wrapping up, quick recap on the 2024 outlook. So fixed income is a highly attractive source of income generation. The highest levels of income that we've been able to generate in over 10 years within fixed income, and acts as a portfolio diversifier, meaning that if the share market was to fall, if economic growth was to slow and inflation to cool, we would expect to see fixed income prices rise, which would certainly be a welcome change from the last year or so. In terms of international equities, as we've talked about before, quality companies like the big US technology and healthcare businesses are expected to do very, very well compared to some of the smaller, lower quality peers, and certainly they would be expected to perform well, even in a period of slower economic growth. Aussie equities, as we've talked about with the franking credit structure that we have here in Australia, generating strong dividend yields. Valuations are a little cheaper than overseas, and within areas like small caps, we do expect to see fund managers able to generate some positive excess returns for investors. And finally, property and infrastructure really is that income piece. And as interest rates do peak, we would also expect to see capital appreciation in that area. And just really a final slide for those clients that are interested in investing in direct shares. Just wanted to spend a minute just kind of showcasing some of the direct shares that we do have in our high conviction list and in our direct model portfolios. So what we're looking at here effectively is the valuation ratio on the vertical axis, and on the horizontal axis we're looking at the next 3 years growth rate of earnings on an annualized basis. So generally what you can see is that higher valuation stocks are expected to deliver more earnings growth. And conversely, those companies that are trading on lower multiples are expected to deliver more modest levels of earnings growth. So if we look at the international shares for a moment, I just want to call out some of those higher quality US technology names, the likes of Microsoft, Alphabet or Google, Amazon, Autodesk, which is a software business, as well as Salesforce, which is the world's leading CRM platform. But it's not limited to technology investments. We've also got payments companies like Visa in there. We've got healthcare businesses like Novo Nordisk, which is one of the world's leading companies servicing the diabetes and obesity markets, as well as Johnson & Johnson and medical device company Medtronic. We've also got European industrial leader Siemens in there with their exposure to industrial automation and electrification trends being the key reasons why we like that business. And then we've got lower growth businesses that are trading on very, very cheap multiples like John Deere and Verizon in there as well, just to provide some good diversification against some of those more growth oriented companies. And thinking about the Australian market, we've talked about income generation a lot. It's really the banks like ANZ, like the big miners, BHP and Woodside paying high yields, as well as Telstra, APA Group, which is the Australian Pipelines business. So those are all sort of more income oriented investments. And then on the growth side, it's companies like CSL, like REA Group, as well as Goodman Group, which is one of the world's largest industrial property businesses, which is exposed to e-commerce trends, which is driving demand for their sheds and their logistics property assets. So hopefully that gives investors a bit of a feel for the types of companies we're investing in when we do go and invest in direct shares, and just kind of shows the spread and range of businesses that we think are very high quality businesses.